Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, and share buttons. Well, they're doing it again. Will the result really be any different? So what am I talking about? Well, first, I want to give a praise to our Lord and God for this past weekend. I was driving the family van and my eldest daughter was in the passenger seat, and we had a deer just run out right in front of the van, smashed into it. We're all right. Obviously, I'm right here, so that's our praise to God. But the family van is in sad shape. We'll find out what the insurance adjuster says, but given how old the van was, it's almost 18 years old. I'm going to think the repair is probably more than what the van is worth, so we're going to need a new family van. But praise to God for the deer didn't go through the windshield, or I may not be here talking right now. So God looked out for us. God looked after us. Just pray for protection throughout your life, because you never know what the day is going to bring. We never know what day might be our last. So make the most of every day you have. So, back to our video. They're doing it again. Will the result be any different? What am I talking about? Well, I'm talking about the real estate bubble that led to the great financial crisis. We're seeing it roll out all over again, the exact same things being done. Will the result be the same? I'm going to say no, and we'll talk about why in just a moment. So let's take a look at this right here. This is from Mike Shedlock's blog. It's called Mish Talk. He says, 0% down mortgages return. What can go wrong, right? No money down at the height of a residential bubble, which we'll look at in just a second. But he says it's a perfect time to do something really stupid, like offering 0% down payments on mortgages. It says Morningstar reports one of the biggest U.S. lenders is offering 0% down payment mortgages for first-time home buyers. Home buyers will be able to buy a home without putting any money down under a new program launched by United Wholesale Mortgage, one of the largest U.S. mortgage lenders. The Pontiac, Michigan-based company's new program will be available to first-time home buyers and people earning at or below 80% of an area's median income, the company said in a press release. So they're going to target it with low-earning people, right? And I understand their thought process. Well, these are the people that need the most help. But they're also the people who are less able to afford it when something goes wrong. Because, so if you own a home, all sorts of things can go wrong and need to be replaced, like the roof or the heating and air system. It says UMWC will give eligible buyers a second lien loan of up to $15,000 in the form of down payment assistance for 3% of the home's purchase price. The loan will not accrue interest or require a monthly payment. So is that really a loan? It says home ownership is something we're very passionate about, Melinda Wilner, Chief Operating Officer at UMW, told MarketWatch. The company had previously allowed buyers to put down as little as 1% on their homes. Of course, that wasn't enough. We had to go farther. It says, but it wanted to go further to help home buyers. The lender is anticipating a higher volume of borrowers with its new zero-down program. Poor underwriting practices were a key driver of the subprime mortgage crisis in the United States, the IMF wrote in 2008. But unlike the low and no down payment loans that proliferated during that time, when lenders made loans to people who eventually were unable to pay them and lost their homes, UMW's program is different. Well, my owner says. And yes, we're going to talk about why this is different. It says the aspect of this program that makes me nervous is the silent second mortgage. Annalise Lederer, Senior Policy Counsel at the Nonprofit Center for Responsible Lending, told MarketWatch. It's great that there's no interest on it, but it's a balloon payment, and borrowers need to understand what a balloon payment is. A balloon payment refers to a bigger than usual one-time payment that's required by the lender at the end of the loan term, according to the Consumer Financial Protection Bureau. On its website, UMW states in the fine print at the bottom of the page that the second loan has no minimum monthly payment requirements, a term of 360 months, just 30 years for those that aren't as good at math, and it says it's fully due as a balloon payment upon the occurrence of either a refinance of the first mortgage or payoff of the first mortgage or the final payment. It says, not unlike 2008. Well, housing prices are stretched. Look at that in a second. The economy is slowing. The lender has no cushion against falling home prices, and there are indications of steeply falling home prices in many markets. Okay, we don't have the massive liar loans like we did in 2008, but mortgage affordability is the lowest ever, and unemployment is starting to kick up. He says anything to keep the bubble going. To top it off, these mortgages are explicitly for people who make 80% or less of an area's median income. How dumb is that? In general, such borrowers have no down payment, if any savings at all, and many are already likely on the edge. It would make more sense giving these mortgages to those who make 120% or more of an area's median income, provided they also have little debt and just lack the down payment. Again, because they would have room if something goes wrong or they lose their job, maybe they have a little bit extra put away and they can weather that storm. The guys, they're right in saying this is not like 2008. Oh, this isn't anything like what we did in 2008. The conditions aren't the same as 2008, right? That's what they say. And they are right. Because as we're going to look at right now, things are worse. Right? So this is the home price to income ratio. So the median home price to median household income ratio. So this means when we look back here at, what are we starting at? The early 1970s, so 50 years ago, you're looking at 3.6 times your income to buy the median house. At the peak of the financial crisis, the real estate bubble that led to the great financial crisis, we were at 6.8. Let me see, that's saying 6.7, I know it's 6.8 somewhere in there. Right? So 6.8 was the peak of the real estate bubble that led to the financial crisis. We're right now at 7.68. So we have a bigger real estate bubble right now, a bigger residential real estate bubble than we had prior to the great financial crisis, which many say was the greatest real estate bubble of all time in residential prices. We're there, guys. We are there right now. So, and we're seeing the same practices roll out with easy credit, no money down, all of these different proposals to get people into homes at any cost, not thinking about can they really afford this. Everything has to go perfectly. If it doesn't, well, then they can't afford the home. And then again, as we saw here, as those prices begin to decline and they have to sell those homes, they're going to be selling them for less than what they paid when they owe more on the home than what it's worth. Therefore, they're underwater. They end up going bankrupt, losing their home, whatever. This makes the situation worse for the people buying these homes. And then of course it has ripple effects throughout the entire economy. Again, this isn't like 2008. It's worse because we're seeing the same bubble and commercial real estate, and that is in the process of bursting for some time now. So let's take a look at this article right here from Zero Hedge. It says, for the first time since the great financial crisis, holders of AAA commercial real estate backed debt are hit with losses. And of course, as we saw during the great financial crisis, AAA, that's supposed to be, oh, that's pristine credit. There's just no way you're going to see any sort of default or losses on that. You can't get any better than AAA. But was it really AAA to begin with? Because we saw all sorts of losses on that type of debt during the great financial crisis, and we're seeing it again. It says, investors holding a tranche of top-rated debt backed by commercial real estate have suffered losses for the first time since the housing meltdown collapsed the economy 16 years ago. This alarming development signals a worsening multi-year downturn in the commercial real estate space, fueled by the Federal Reserve's interest rate hiking cycle and plummeting office tower values nationwide. Bloomberg first reported that commercial mortgage-backed securities strategist at Barclays pointed out that buyers of the AAA portion, so they broke this up into portions with different ratings. So the AAA portion, that again is the most pristine. This is, your odds of default on this are 1 in a trillion. Of a $308 million note backed up by the mortgage on 1740 Broadway building in Midtown Manhattan, received less than 3/4 of their initial investment in recent weeks after the loan was dumped at a sizable discount. All lower tier creditors were wiped out. So out of this $308 million that was loaned for this building, you had a AAA rated portion. Those investors have now lost 26%. Then you had a AA minus, right? Yeah, not quite AAA, but it's AA, but not quite AA. It's a AA minus, right? And then you got A minus, triple B minus, double B minus, and B plus, right? They don't have a triple B plus or just a triple B. Yeah. And I'm joking about this because none of these mattered. Look at the outcome. Everyone who invested in these portions lost everything. 100%, 100%, 100% loss. If you were in the top tier, the most wonderful of all of these debt tiers, oh, well, you only lost 26%, right? Just 26% loss. Good thing you weren't in the other ones where you lost everything. It says, now that we've seen the first commercial mortgage-backed securities get hit, other AAA bonds are bound to see losses. Leah Overby, a CMBS strategist at Barclays, wrote in a note, adding, these losses may be a sign that the commercial real estate market is starting to hit rock bottom. Or they may be a sign that things are about to get much worse, right? So it doesn't mean things are getting better when you start losing everything, unless you're in the top tier in which you only lose 26%. With about $700 billion of non-agency CMBS outstanding and another $3 trillion in commercial mortgages on bank balance sheets. Again, some of these are on bank balance sheets, guys. Even a modest uptick in losses could weigh on the financial system for years, Bloomberg journalists said. They were quick to note, to be clear, nobody's predicting a repeat of 2008 when bad mortgages, mostly residential, nearly brought down the financial system. Well, maybe at their place where, when you're on Wall Street like this, you never make any predictions that are outside of what the crowd is saying. Because if you do that and you're wrong, well, then you get fired. But if you're consistently wrong over the course of your entire career, but all of your colleagues were also wrong, well, you're fine, right? Nothing happens to you because, yeah, I was wrong, but everybody else was too. But if you come out and you say, hey, I think we're doing the same things that we did 15, 16 years ago when, the whole global financial system almost got destroyed, and you're wrong that month, they'll fire you. 2 years later, it might turn out, oh, what? You know what? They were right. Where is that person? Oh, we fired them 2 years ago because they made some outlandish prediction, right? We want to make it clear nobody's predicting a repeat of '08. Well, a whole bunch of people who aren't on Wall Street are. Count me as one of them. Yes, we're going to see a repeat of '08, but worse, right? It's going to be worse for some of the reasons we just looked at. We're at an even bigger residential housing bubble than we were in '08, and that hasn't even begun to pop yet. That hasn't burst. We're just talking about commercial real estate right now. This says what's troubling is that $52 billion, or 31% of all office loans and commercial-backed securities, were in dire straits in March. That's up from 16% a year ago, according to KBRA Analytics. The firm said some cities are facing more stress than others, including Chicago and Detroit. And guys, we talked about there's more of these loans coming due this year. 89% of those loans are interest only. The properties have plummeted in value. They will not be successfully refinanced at higher rates. They'll simply be defaulted on. Those that took out the original loan are going to walk away, and the bank's going to get stuck with it. And this is going to have huge implications for the banking sector. We're going to have another crisis worse than the great financial crisis. Guaranteed. Let's take a look at what's going on with the average consumer in the economy. So this is from Federal Reserve Bank of St. Louis. This is net saving as a percentage of gross national income. So what percentage of people's income are they saving? And as we see, data going back to 1947, only time this has been negative was during the great financial crisis, for one quarter during all the COVID shutdowns, and right now, the last 5 quarters. So since the beginning of 2023 to now, this has been negative. And again, unemployment is, it's at a historic low. What happens to this if massive layoffs come? So guys, the situation right now, I believe, is worse than what we saw in 2008, 2009. Well, worse than 2006, 2007, and we're heading toward worse than 2008, 2009. We have bubbles form not just in residential real estate, but in all of real estate, the stock market, and the bond market. And the only one of those markets that we're seeing burst has been the bond market. That's what's put the banks in trouble. That's why the banks are sitting on $600 billion of unrealized losses right now. And the commercial real estate portion of the real estate market. Once we see the free fall in the residential real estate market, once we see the job losses mount, we're going to see the stock market plummet. All of those bubbles are going to burst simultaneously. What is going to be that trigger? I don't know. We talked about several of these over on the Substack, brittgillette.substack.com, and 6 potential triggers for the next global financial crisis, and we had a number of ideas of what that might be. I don't know what that trigger is going to be, but I can tell you this. When that trigger occurs, you'll know it by watching this. And we've talked about this before. This is the U.S. 2-year, 10-year spread. When you see this go negative, which it is right now, that's a sign that a recession is coming. This going back over 50, 70 years. I forget how long it's been. It's been at least 50. This has accurately predicted every recession in U.S. history. Now, it's only does so, the recession, the wheels come off the bus, so to speak, not when this goes negative, which is called an inverted yield curve. You might hear mention of that in the news media. But the wheels come off of the bus once this goes positive again. So this went negative 2 years ago in June of 2022. To my knowledge, this is the longest period of an inverted yield curve in history. Now, does that mean that this is going to be the worst economic crisis once this uninverts? It doesn't necessarily mean that. However, I will say that is the case because that's what's coming, guys. It's not just the United States facing all these problems. We're seeing this globally. We see China in the grip of a deflationary spiral. We see the deindustrialization of Germany. We see problems with the global banking system, problems with fiat currency and debt. Now, many people say, well, all of these problems, they'll be solved when these bubbles burst, the Fed will cut rates, and then we'll have 2% mortgages again, and everything's going to be wonderful. Because what happens with all the debt, the $34 trillion in debt, adding $1 trillion to the national debt every 100 days, over $1 trillion in annual interest on the national debt. What happens when the Federal Reserve says, we're going to cut rates? Don't worry, it's an emergency, we're going to cut rates. And instead of the interest rates going down, they go up. Because the market says, wait a second, time out. You've been running multi-trillion-dollar deficits with record low unemployment, never saying everything's great. Now you're in a crisis. People are getting laid off. You're going to introduce all these additional programs to hand out free cash to everybody because of the terrible crisis. Food stamp usage is going up. Entitlement benefit usage is going up, and you're gonna run $10 trillion annual deficits. I'm gonna need a much higher interest rate to buy that U.S. debt. So what happens when the wheels fall off the bus and instead of the interest rates going down, they go up? Then you have a currency crisis, you have a debt crisis, the likes of which we've never seen before. I think that's coming, guys. We're going to see the greatest financial crisis in history, greatest economic crisis in human history on a global scale, worse than the Great Depression, not as long in duration, but it's going to be bad, and they're going to use that. The way all this relates to Bible prophecy, because we've been seeing they're rolling out. They want central bank digital currencies. They want everybody to have that. And this will be the catalyst. This will be their stated reason for rolling that out and forcing everybody to use it, laying that trap, having the world walk into it. Once everyone accepts central bank digital currency, they'll close the door on that cage and there will be no escape. All of this sets the stage for the tribulation period and the mark of the beast, because as we've stated, the central bank digital currency, all these measures they're rolling out for surveillance and tracking and programmable currency, all of that is indistinguishable in function from the mark of the beast. While it's not the mark of the beast, it gives government the power on par with the mark of the beast. So guys, how far away are we from all of this? I have no idea. Again, we talked about 6 of those potential triggers, the last of which I believe is the rapture of the church, because all of these pressure points that we're seeing in the global economy right now, everything would collapse in an instant the moment the rapture of the church occurs. So as this tells me, we're late, and the hour is late, and Jesus is coming. So let me know what you think. Leave your comments below. Make sure to hit the like, share, and subscribe buttons. God willing, I will see you on Wednesday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.